Imagine an asset that has plummeted from nearly $600 down to roughly 21 bucks.
It's just a brutal chart.
Right. I mean, Wall Street trading algorithms are screaming like, strong sell, they're dumping shares by the millions.
Yeah, completely fleeing the scene.
But then you look in the forums, the comment sections, and contrarians are whispering that this might be, the most violently coiled spring in the entire stock market.
Which is a huge claim to make right now.
It really is. So, welcome to today's deep dive. It's April 14, 2026. And our mission today is to unpack the extreme plunge of this very specific, highly volatile tactical tool.
Ticker symbol SOXS.
Exactly. The Direxion Daily Semiconductor Bear 3X ETF.
Yeah.
We're going to look under the hood to figure out what the data actually says versus what the hype is, trying to sell you.
Yeah, because it is a fascinating and, frankly, just a devastating landscape to analyze today. We're talking about an instrument that's designed with a very singular aggressive purpose, right? To go up when semiconductor stocks go down, and to do it with triple the leverage.
Right, 3X leverage. But right
now, it is getting absolutely crushed, just flattened by this unstoppable historic rally in the chip sector.
Yeah, the AI rally is just eating it alive. But before we really unpack the mechanics of this drop and figure out if this thing is actually dead or, just sleeping, I need to ask you, yes, you, listening and watching right now, to please like this video and subscribe to our YouTube channel.
Emphatically.
Yes, emphatically. We compulsorily want you to leave your comments and feedback down below. Like, what are you seeing in the market? We want to know.
Definitely. The comments have been great lately.
They really have. So, okay, let's set the stage here. SOXS is a tactical tool. It's built for short-term, inverse exposure to the semiconductor sector.
Basically, a way to bet against the chip makers multiplied by 3.
Right. But it's in a crisis. It's completely battered by this prolonged AI-driven rally. So, to really get this, we need to look at its exact financial footprint as of today's close, right, to see the sheer scale of the drop.
Yeah, and this is where people get tripped up. When investors look for a bargain, they usually hunt for traditional corporate financials.
Like income statements.
Right. Income statements showing quarterly or annual revenue, or balance sheets with physical assets, cash flow statements.
The usual stuff.
Exactly. But because SOXS is an exchange-traded fund, and a highly specialized one at that, looking for those traditional metrics will lead you right into a trap.
I think that's an incredibly important distinction for anyone trying to apply, like, standard value investing rules here. Because appraising a standard stock is like evaluating a business, right? You look at the cash in the register, you look at the inventory in the back. But appraising a 3X inverse ETF is like, I don't know, evaluating a mirror maze.
A mirror maze. That's actually a perfect analogy.
Right. You aren't valuing a company. You're valuing a basket of daily derivative contracts that are designed to perfectly reflect the exact opposite of what the real companies are doing.
Yeah, the mirror maze is the right way to think about it. For a leveraged ETF, health isn't measured by, corporate profits or quarterly sales.
What's it measured by?
It's measured by net asset value, NAV, and asset flow. The NAV represents the total value of all those derivative contracts they hold, divided by the number of shares.
Okay, and what are those stats looking like right now?
Well, they paint a pretty stark picture. As of today's close, total net assets, the AUM, sit at about $855.7 million.
Okay.
And there are roughly 70.25 million shares outstanding.
Got it.
And crucially, for a complex instrument that requires, constant daily financial engineering, the net expense ratio is incredibly high. It sits at a full 1.00%.
Wow. So 1%, which means the fund managers are taking a 1% cut just to keep the lights on and manage all those complex swaps.
Exactly.
Yeah.
Every single day.
Man. So if the basic financials like NAV and these high expense ratios are kind of distorting reality, the only objective truth left is the actual price action at the closing bell.
And that price action is breaking people's brains right now.
It really is. Let's talk about the stock price, the news, the quote history. Because SOXS closed today at $21.05.
Yeah, 21.05.
And it has fallen for 10 consecutive trading days. 10 days of just red. It's trading near its absolute 52-week low of $21 even.
Down from a staggering 52-week high of $585.60.
Which is just, it's breathtaking. A drop from $585 down to $21.
It is. And that kind of drop creates these bizarre statistical illusions that actively trap unwary retail investors, people who might be just using basic stock screeners.
Wait, what kind of illusions? Give me an example.
Take the dividend, for example. The most recent dividend paid out was 29 cents per share, with an ex-date of March 24th, 2026.
Okay, 29 cents. Doesn't sound like much.
Right. But because the stock price has fallen so drastically since that payout was calculated, standard financial platforms see a 29-cent dividend on a $21 stock, and mathematically they spit out a massive 14 to 16% trailing yield.
Oh, wow. Oh, I see. So someone who's just screening the market for like high-yield dividend stocks might see a 16% yield on SOXS, think they found a gold mine, and just buy in.
Without realizing what's actually happening under the hood, yeah.
That is dangerous.
Very. That yield is entirely an illusion created by extreme price depreciation. The denominator, the stock price, shrank so rapidly that the yield percentage artificially ballooned.
So it's not a sign of financial health at all.
Not even a little. It's a mathematical symptom of a crash.
Okay, and the order flow completely reflects that reality. We're seeing massive selling volume. We're talking about roughly 69 million shares traded in just the last session.
Which is huge volume.
Huge. But here's the thing that puzzles me. With a drop from 585 down to 21 and 69 million shares changing hands, someone has to be on the other side of those trades, right?
Mathematically, yes.
So who's buying? Is there like a smart money stepping in, or is this just a mass institutional exodus?
It's an exodus. The institutional money is actively fleeing. Big funds are rotating heavily into risk assets and, bullish counterparts like SOXL to chase the AI supercycle.
So they're dumping their hedges.
Exactly. The buying you're seeing, those 69 million shares, is largely a mix of algorithmic trading systems, scalping pennies, day traders trying to catch a falling knife, and market makers who are legally obligated to provide liquidity.
Ah, right, the market makers.
Yeah. When a retail trader decides to buy 100 shares hoping for a bounce, a market maker sells it to them, usually hedging their own position somewhere else. It's transactional friction. It is not fundamentally driven long-term accumulation.
Okay, so the smart money is out, and the volume is just transactional noise.
Pretty much.
So we need to look at what those trading algorithms and technical charts are actually reacting to. Let's get under the hood with the technical analysis.
Let's do it.
I'm looking at the momentum indicators. Specifically, the 14-day Relative Strength Index, the RSI, it's hovering between 19.34 and 30.39. Now, my understanding is anything under 30 puts an asset in extreme oversold territory, right?
Spot on. The RSI measures the speed and magnitude of recent price changes, basically to evaluate whether an asset is overvalued or undervalued in the immediate term.
Right.
Dropping below 30 signals that the selling pressure has been so intense and so relentless that the asset might be exhausting its downward momentum.
And it hit 19.
Hitting 19 is a rare extreme level of exhaustion, but, momentum is only one part of the picture.
Right, which brings me to the MXED, the Moving Average Convergence Divergence.
Yeah.
I'm looking at the data here, and it's deeply negative at negative 1.875, and the histogram has been consistently negative since April 2nd. My instinct is that a negative number for this long shows sellers are running out of steam.
Yeah.
But how do algorithms actually read a sustained negative histogram like that?
They don't read it as exhaustion. The algorithms read it as accelerating downward velocity.
Oh, really?
Yeah, the MAFC looks at the relationship between two moving averages of prices, usually the 12-day and the 26-day.
Yeah.
When the short-term average drops faster than the long-term average, the MACD turns negative.
Okay.
A sustained, growing negative histogram means the selling isn't just continuing, it's physically speeding up. The short-term price is literally collapsing out from under the long-term trend.
Wow. And the simple moving averages completely confirm this detachment from reality.
I really do.
Like the current price is 21.05, right?
Mm-hmm.
That is 40% below its 20-day simple moving average, which sits at 35.03.
And the 50-day is at 35.85.
Right. And the 200-day moving average, which I know institutions watch like a hawk, is miles away at $82.52.
Which is a massive gap.
Yeah. That gap between 21 and 82, that must act as a massive psychological barrier for any real institutional buyer thinking about a long-term position.
Definitely. It creates a ceiling of trapped buyers.
Yeah.
Think about it. Anyone who bought at 40, 60, or 80 is just waiting for the price to recover so they can break even and sell.
Right, they just want out.
Exactly. That creates immense overhead resistance. Immediate resistance, the ceiling the price would have to break through just to show a pulse, is currently at 26.75 and then 36.42.
Man. So what about support? Like, where do the charts say this thing might actually stop bleeding and find a floor,
Well, the only current support is that 52-week low of $21.
which we're basically at right now?
Right. And if that psychological floor breaks, the technicals get very dark. There's a charting model known as a fan theory projection, which connects a series of descending peaks to predict future downside.
Okay, and what does the fan theory say?
It suggests that if the current trajectory holds and the momentum doesn't shift, we could see a horrific lower bottom near $8.37.
$8.37,
Mm-hmm.
down from 585.
Yeah.
It's no wonder that the ratings and signals, summaries from places like TradingView and Investing.com are overwhelmingly screaming strong sell in the short term.
The broader semiconductor index is on a record-breaking tear, and this inverse ETF is just absorbing all of that punishment.
Right. But, okay, let me push back on that strong sell rating for a second. Let's use the analogy of a stretched rubber band.
Okay, let's hear it.
If the RSI is historically deeply oversold at 19, doesn't that rubber band eventually have to snap back?
In theory.
Like the more you stretch it downward, away from those moving averages, the more potential energy is coiled up.
Yeah.
If I'm a contrarian trader, I'm looking at that massive gap and thinking these extreme negative signals should actually be a highly tempting trigger for a quick, violent, short-term bounce.
And look, in a traditional corporate stock, the rubber band theory holds up beautifully. You stretch it too far from its moving averages, the selling exhausts itself, and it snaps back to the mean.
Right.
And an algorithmic relief bounce is absolutely on the table here, but we have to remember this isn't a normal stock.
Which brings us to the biggest debate retail traders are having right now.
Undervalued versus trap.
Exactly. Are we looking at a deeply undervalued asset or a classic devastating value trap? Is it a coiled spring or is the spring just fundamentally broken?
Yeah, let's unpack the mechanics of that because this is where the heartbreak happens for a lot of retail investors who think they're outsmarting the market.
Yeah, let's talk about the downside risks. You mentioned this isn't a normal stock.
Mm-hmm.
It's a leveraged inverse ETF. And that introduces something incredibly insidious called volatility drag or volatility decay.
Yes, this is the single most vital concept to grasp when looking at SOXS. These instruments are rebalanced daily. They are mathematically designed to give you 3 times the inverse return of the semiconductor index for one single trading day.
Just one day.
Not a week, not a month, just today.
I always think of it like holding a leaky bucket.
That's a good way to put it.
Let's say you buy SOXS because you strongly believe a market correction is coming in the next few months. You're trying to catch the falling water perfectly.
Mm-hmm.
But the bucket itself is mathematically designed to leak overnight through that daily rebalancing process.
Exactly.
Even if your broader thesis is completely right and the semiconductor market eventually drops, if it took 3 months of choppy trading to happen, aren't retail traders just paying for the privilege of holding a defective bucket?
They absolutely are. And the math behind that leak is punishing. Imagine the underlying semiconductor index drops 5% today. Because of the 3x leverage, SOXS goes up 15%.
Great. You feel like a genius.
Right, you feel great. But tomorrow, the index recovers that 5%. SOXS now drops 15%. However, it is dropping 15% from a new, higher base price.
I see.
You lose more absolute dollars on the way down than you gained on the way up. In a market that just chops around sideways with high volatility, that daily compounding math actively destroys your principal. You bleed out while waiting to be right.
Wow. And the undeniable proof of this decay is in the corporate actions of the ETF itself, right?
Yeah.
Because SOXS isn't just dropping organically. It recently underwent a 1-for-20 reverse split.
Yeah, let's break down why that happens. Major stock exchanges have minimum bid price rules. If an asset trades under $1 for too long, it faces delisting.
Right.
Because of the volatility decay we just discussed, inverse leveraged ETFs naturally trend towards zero over long periods. So to prevent being delisted and restricted by institutional platforms, the fund managers artificially bundle the shares together.
Right. So a 1-for-20 reverse split means if you held 20 individual shares valued at, say, pennies, the fund consolidated them into one single share, adjusting the price upwards just to keep up appearances.
Exactly. It doesn't change the overall market cap or the value of your portfolio. It just hides the decay.
Wait, so that staggering $585 high from earlier?
That number is historically adjusted for the reverse split. The asset didn't actually trade at $585 per share in reality.
Oh, wow.
Yeah, the historical charts are retroactively multiplied by 20 to account for the split.
Hmm?
The sheer fact that a 1 for 20 reverse split was necessary just to stay viable proves the verdict here.
Which is?
The mechanics dictate that this is not a fundamentally undervalued stock to buy and hold. It is a decaying tactical instrument that will systematically drain long-term holders.
Okay, so holding this long-term is definitely like holding a leaky bucket. A trader's success depends entirely on immediate short-term catalysts. You have to get in, get the spike, and get out before the decay eats your profit.
Precisely.
So let's run through the specific market scenarios. The bull versus bear case. What could save SOXS and what could bury it even further? Let's start with the worst case continuation lower.
Okay, the bear case. Betting against SOXS, which translates to continued unstoppable strength in the AI and semiconductor sector. The momentum right now is viewed by Wall Street as a structural paradigm shift. We're looking at massive real-world AI infrastructure spending. Projections show that companies like OpenAI and Broadcom alone are aiming at a staggering $500 billion in capital expenditure by 2026.
$500 billion.
Yeah.
And that isn't just like software development. That is physical data centers, cooling systems, millions of advanced processing chips. That is an ocean of physical capital flowing directly into the balance sheets of the companies that SOXS is betting against.
Add to that, Taiwan semiconductor manufacturing company TSMC recently reported a 35% revenue surge.
35%.
Yeah, the underlying fundamentals, the actual cash flow of the chip makers are incredibly strong, which justifies the high valuations. Furthermore, macroeconomic fears that normally drive investors into defensive hedges are easing.
Right, and before we dive into these specific geopolitical triggers, I need to make something very clear for our listeners. As we bring up U.S.-China trade policies and Middle Eastern conflicts, we are strictly analyzing how these events impact semiconductor supply chains according to the market data.
Right.
We aren't taking political sides, we're not endorsing any geopolitical viewpoints, we're just following the money and explaining how the algorithms react.
Exactly. And with that in mind, the market data shows that the reported U.S.-Iran ceasefire has drastically reduced geopolitical anxiety in the energy sector and global shipping routes.
Makes sense.
When that anxiety drops, the market rotates massively away from defensive hedges like SOXS and directly into risk assets. The market hates uncertainty, and right now the perceived certainty is very high.
But let's flip the board. What is the bull case for SOXS? What is the best case recovery scenario where that rubber band actually snaps back and the contrarians make a fortune catching the bottom?
The bull case relies almost entirely on sudden macro shocks, or what analysts are calling AI fatigue.
Okay, explain that.
From a purely technical standpoint, because the RSI is so deeply oversold at 19, any slight miss in upcoming AI earnings could trigger a violent 20 to 30% relief bounce.
Because it's priced for perfection.
Exactly. The semiconductor market is priced for absolute perfection right now. If a major chip maker comes out and says, well, revenue is great, but our forward guidance for the next 2 quarters is slightly softer than expected, you will see an immediate aggressive sell-off in the sector and SOXS will spike.
And what about the geopolitical side? We just talked about a ceasefire easing tensions, but there are always tripwires in the global supply chain, right? Especially for semiconductors, which are arguably the most complex physical items humanity manufactures.
Oh, absolutely. The geopolitical triggers are the ultimate wildcards for this ETF. The data highlights tightening U.S.-China export controls, specifically focusing on advanced AI hardware like the H200 chips.
Right.
If those trade regulations get harsher, it instantly slashes the projected global revenue of the top U.S. semiconductor companies.
Okay, that would be a huge catalyst.
Plus, you have the ever-present systemic risk of supply chain disruptions in the Taiwan Strait, where the vast majority of high-end manufacturing occurs. Or if the Middle East ceasefire fails and regional conflict escalates, the broader market will panic, risk assets will be liquidated, and defensive inverse ETFs like SOXS will suddenly become the only safe haven for traders looking to hedge their portfolios.
But I have to challenge you on the timeline of those catalysts, though.
Okay, go ahead.
We hear about this $500 billion AI CapEx dream, right, which is massive, slow-moving institutional money. It takes years to actually deploy and build out those data centers.
Sure.
But how quickly could a single hardware supply chain shock or a sudden export control announcement from the Commerce Department turn this chart's strong sell signal into a massive green candle for SOXS?
It would happen in milliseconds.
Really?
That is the true nature of a leveraged inverse ETF. The 500 billion capital expenditure is a multi-year structural trend that builds an economic foundation. But the stock market trades entirely on future expectations. A sudden supply chain shock in the Taiwan Strait wouldn't just affect next quarter's earnings. It would instantly force high-frequency trading algorithms to reprice the entire decade of AI revenue expectations.
Because everything is interconnected.
And because SOXS is triple leveraged, it would react with extreme volatility. It could gap up 15, 20, or 30% in a matter of minutes at the opening bell.
So weighing all of this together, we have the unstoppable, undeniable force of the AI supercycle, backed by hundreds of billions in real-world spending, colliding against highly volatile geopolitical tripwires that could, trigger at any moment. Where does that leave us? Let's bring this home with a final outlook summary. Short-term versus long-term perspective.
Well, the data leads us to separate this into two distinct timeframes. In the short term, you should expect continued weakness, but recognize that there is a very high potential for violent algorithm-driven relief bounces.
So high risk, high reward.
Extremely high risk. It is a highly dangerous environment for short sellers to get greedy, given how deeply oversold the momentum indicators are.
Right.
But in the long term, the perspective remains historically poor. The inevitable mathematical decay of daily rebalancing, combined with the structural headwind of the AI revolution, means this is absolutely not a buy-and-hold investment. It is a surgical, highly specialized trading tool.
And before we wrap up, we absolutely must state clearly, this natural debate we're having today is purely an analysis of the sources, the data, and the intricate market mechanics of leveraged ETFs.
Yes.
It absolutely does not constitute financial advice. We are breaking down how these complex instruments work under the hood, not telling you what to do with your portfolio.
Always do your own deep due diligence, especially with leveraged inverse funds. The risks of total capital loss are very real and mathematically proven.
Exactly. So we started today by looking at a financial chart that looks like it fell out of an airplane. From $585 down to $21.
A historic drop.
We looked at the leaky buckets of volatility drag, the reality-distorting reverse splits, and the 69 million shares changing hands as the algorithms battle it out over pennies. And honestly, it leaves us with a deep, lingering uncertainty about the actual structural integrity of this specific slice of the financial market.
It truly is the ultimate standoff between massive macroeconomic momentum and the unforgiving micromechanics of daily leverage.
Which brings me to a final thought I want to leave you with. We've spent this time talking about how these funds decay and the risks to the individual retail trader holding the bag.
Right.
But think about the broader picture. If a single hyper-niche instrument like SOXS requires billions of dollars in daily liquidity and complex derivative swaps just to function while it mathematically decays, what happens to the broader market stability when the algorithms trading these obscure tools suddenly miscalculate?
That's the real question.
Are these highly leveraged decaying ETFs safely isolated, or do they introduce a hidden systemic fragility into the very semiconductor stocks they are betting against?
Something to mull over.
Definitely. Let us know what you think in the YouTube comments. We want to hear your theories on the ripple effects of leverage. Until next time, keep digging, keep questioning, and keep exploring the deep dive.